Well, let's discuss markets and more now with Shreyas Devalkar, the Senior Fund Manager for Equities at Axis Mutual Fund. Good morning. Thank you so much for joining us. The big theme that, of course, was playing out yesterday was the nervousness that had crept into the markets. But Shreyas, another way of looking at it is that if I were to look at it from the month of January, the way our markets have done, not once have the markets closed more than 1% lower monthly. I'm looking at. Isn't it time that we embrace the correction, maybe look at it as an opportunity to buy, to accumulate?
So any correction always offers an opportunity to buy. If you look at what has happened in the market over last 1.5 years, many sectors actually got re-rated a lot, barring probably banking and financial sector, services sector. Every other sector is at its peak valuation compared to pre-COVID peak. While in case of banking and financials, the valuation, especially as measured by price to book, is not at its pre-COVID peak. In most of them, not probably all of them. So in this, the pack which has gone up and the valuations are very high, definitely one should look at these corrections to buy, especially.
So when we decode this sell-off and the nervousness that has started to creep in, the run-up that we've seen, let's say in the sector like specialty chemicals, one was trying to figure out how is it like this? Why is it matching the valuations of the consumer stocks? Do you think this is the time we're going to see maybe sanity reign in? Maybe, stocks like those in in specialty chemicals have peaked out in that sense?
Yeah, if we discuss only about valuations, then it's a judgment for everyone to use. If we use the core valuation philosophy, which is free cash flow generation, then definitely these multiples are high because the nature of the business is you need to do capex for growth. So the free cash flow generation, free cash flow to PAT, these ratios are definitely inferior to a typical FMCG industry, and that actually lends us to relatively lower valuation compared to high free cash flow generating companies like even IT or for that matter FMCG. But something here one need to understand is probably market has valued them today in the sense in last 1.5 year more so. But the trend and the story has panned out over last 5 years. And there in last 5 years, most of these chemical companies, they having found out their niche in a particular area of manufacturing chemical, and then actually most of these companies are there for last 15-20 years. They were showing really good numbers for last 5 years, and during this time post COVID, actually the B2C segment of the market got hurt because of mobility challenges. It can be again banking or some consumption related companies. While on the other hand, these companies definitely benefited from China plus one to their ability of those companies to particularly expand their horizon from say agrochemical to pharmaceutical API and so on. So whichever company normally, historically what we have seen, it moves out of its older orbit. So most of these companies which got re-rated, actually they moved out of their orbit. So if they were focusing only on agro, they also focused on pharma. And if they were focusing on only one chemistry, they were trying to get into something else and they succeeded there. So these are the other elements which actually helped in re-rating. But if you definitely use a traditional metric like this year, then these valuations, especially because of the free cash flow profile, are definitely high.
Sure. The other thing, Shreyas, that I wanted to talk to you about was whether or not in this decline or post this decline, Is there merit in reallocating and trying to get a little bit market cap agnostic? I was just looking at your fund performances as well, year to date, as well as on a 3-year and 5-year return basis. But that aside, while up until now it's been a pretty broad-based move that you've seen for the markets, and some of the large cap contenders in the markets may have fallen a lot more from the October highs as opposed to the broader market correction. But once the selling gets done, would you be more concentrated perhaps on any of the market cap categories? Or does it continue to remain a stock specific game?
I think it will continue to remain stock-specific game. It will be market cap agnostic. The reasons are especially in the stories to play. If you look at large cap or Nifty as a benchmark to it, then what is highest in it is somewhere 35% to 40%, somewhere there, is the banking and financial services sector. Now that sector has shown dual challenges in some time in recent past. One was on the credit growth, and the other one was around the fintech related onslaught is happening globally. And that is one of the reason. And again, when it comes to the lower credit growth, what we attribute it to, that is most important part. Because today, what we observe is we focus on the corporate credit growth, but the fact of the matter is corporate credit growth was slowing down since last 5 years. So even pre-COVID, you would have noticed that the banks and NBFCs, those who were retail focused, they gave you higher return compared to the corporate credit growth focused bank and NBFCs, and precisely for the reason that was slowing down since 2015. While the retail credit growth has been the story for a decade or so, with almost 14-15% CAGR growth. Now this retail growth story got affected because of COVID, both on the NPA front as well as on the growth front. Now this pack, that's where, in my opinion, if retail growth story picks up, then the bank and NBFC which are focused on the retail credit growth can be a good consideration for anyone. While on the other hand, corporate growth, as I said, has been slowing down since 2015-16. And again, always there used to be hope that yes, now this corporate credit cycle will help it pick up. But then in last 4-5 years, it never happened. So let's see. Even now, some experts believe that it will. But I would rather focus on the retail credit growth, which has been doing very well since last 5 to 6 years. And that is the reason why the large caps, actually because of this entire pack, one of the reason, again, as I said, has underperformed, because in the mid cap index, broadly 20% is financial services. In large cap index, it is 35-40, and that gets reflected in the funds across the category. Now, if you remove this and then look at all the rest of the opportunities, then there are many companies, as you highlighted, one of them being specialty chemical, others could have been, and many sectors, it could have been textile, it could have been consumer durable, it could have been even auto ancillary. Some of them have done really well, and such opportunities, some are niche opportunities wherein someone may be doing something for EV industry, or in case of manufacturing industry, there could have been some opportunities. So those opportunities are definitely widespread across, and that's where market cap centric approach may not help, and that's where the stock specific approach will be more suitable in this.
Sure. What about IT as a category, Shreyas? Is the easy money and the low-hanging fruits now behind us, or do you believe that at a time when the industry is facing acute attrition challenges and thereby the wage inflation only going up higher, there is still scope for re-rating in the long term?
Sure. In IT industry, again, I would classify the re-rating which happened in the IT, also the same reason as post COVID, generally B2C as a pact, underperform B2B as a pact. And so in that B2B, you have IT, which got re-rated. There can be specialty chemical, which got re-rated, and so on. So so this is one of the reason, apart from many, that IT got re-rated during this time. And definitely, not to take away from them, the growth has accelerated a lot, and that too across the board for the first time. So probably last time, I don't recollect what, probably in last decade we have seen that all the companies across the market cap, irrespective of their size, are showing good results. Such kind of scenario probably was seen in last 1 year in the IT as a sector. Having said that, yes, like every other non-banking, non-financial related sector, the valuation here are also elevated compared to their earlier peak. So this growth on the top line front, in my opinion, is utmost important because cost-related items, maybe wage inflation or probably post opening up, the travel cost may also creep in 1.5 year down the line, full-fledged, and one may would like to focus on that as well at that point in time. But to me, as long as the top line growth is there, I think all these cost-related items can take care of itself because these are good problems to have in a good times rather than no growth at the top line and only wage inflation. That is really a sad part of it if it happens. So as long as the growth on the top line is surprising, is in double digits, I think it should be good enough for the sector.
Shreyas, great to gather in all that information from you and great to get in your insight.
Thank you.